Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage, and welcome to another edition of Java with Jared. Hope you guys are doing fantastic. I have to do a little talk here at the Inverness Hotel, but I wanted to get with you and let you know what was going on with interest rates, because it has been ugly, ugly, ugly. Mortgage-backed securities have really taken it on the chin the last 30 days. We've lost almost 400 basis points, and that translates into interest rates going from about 3.375 for a 30-year fixed-rate mortgage with good credit, good down payment, all that stuff, to 4. So it's been a huge movement, and it all started the beginning of May when we saw the unemployment report come out, showed that the unemployment rate was at about 7.5%. The target rate for quantitative easing is about 6.5% to quantitative easing to begin tapering down. That's what the Federal Reserve has said, so we're getting close to that level. And that has caused the market to begin to prepare for quantitative easing to end. Now, it came to the forefront again here on Tuesday when the market got killed because Ben Bernanke testified before Congress, which he does every couple of months, and he had a written testimony statement that he talked about that the Federal Reserve needs to be very careful about prematurely increasing rates or affecting rates to the negative to cause the economy to falter, which would be good for interest rates. That was okay. But then during the question and answer period, someone asked him about when they're going to end quantitative easing, and he basically indicated, well, if we see real strong economic data, we might begin tapering that down actually very, very soon, June or July. I don't think that's going to happen, but that's what it indicated, or at least that's what the market perceived from that. And mortgage-backed securities sold off big time. We lost 100 basis points in the day. It was really brutal out there. So interest rates have really taken it on the chin. Now, I don't believe that we're just going to go skyrocket from here. There's enough stuff in the overall data that's going to keep interest rates pretty low. Now, will we be in the low threes? Probably not. We're probably going to be just varying between maybe, the low fours and the high threes. We're going to have good days and bad days. And that's because we still see enough economic data that is cause for concern. We have Europe. The Eurodrama is not over yet. The EU released the quarterly GDP, or at least their equivalent. It showed for the 6th quarter in a row they're still in a recession. We also have seen pretty tepid economic data, but for housing starts, or the whole housing economy. Housing has been great numbers, and we saw good numbers this week showing that there's really robust data in the housing market, which we all know, but that's the only bright spot in terms of the economy. Otherwise, it's pretty tepid. We also have seen really, really low inflation numbers. CPI and PPI, those came out earlier in the week. They showed inflation is really not a concern, only at levels of 1.7%. So low inflation is great for interest rates, so that is good. And there's just generally not a lot of really strong data. We also have seen the labor force participation rate, which I've talked about, at the worst levels in over 30 years. So that's going to keep that unemployment rate actually probably from pretty high. It's going to keep it from going down, because remember, if someone's not looking for a job, they're not considered on the employment rolls. So as soon as they start looking for a job, they're back on the unemployment numbers, and that's going to keep it from getting down below that or at that 6.5% level. It's going to keep that unemployment rate pretty stubborn. So I don't think that we're going to see really super high interest rates from here, but most economists predicted by the end of the 4th quarter anyway, we would be seeing, around 4% level, and here we are. Now, I don't think we're going to stay here. We'll probably get a correction, and we will eventually see, high threes again. But I think that we are, I don't know if it's really likely we're going to see 3.375 again. So remember, keep our clients focused on the fact, though, that a 4% interest rate is fantastic. You got to be happy with it. Just because they may not get that low 3% 30-year fixed rate, that's all right. Got to keep them focused on what is really, really fantastic interest rate. So that's what's going on. I'll keep you informed with what happens next week. The next unemployment report is going to be a pretty strong or a pretty good number that the market's going to follow to the next direction of interest rates, and we'll see that in a couple of weeks. If you guys have any questions, please give me a call. I hope you have a wonderful Memorial Day weekend. Enjoy the extra day. If you have any questions, please give us a call. Thanks for joining me with Java with Jared. We'll talk to you soon. Bye-bye.